Hi, everyone, and welcome back to Finance Girl in Cyberspace. I'm Heiress, your guide to decoding money, credit, and the digital economy one step at a time. Today, we're diving into debt, credit, and the exact steps you can take to build a strong credit score that actually works in your favor. Your credit score affects nearly every major financial move you'll make in life, whether you're applying for an apartment, trying to get approved for a car loan, buying a home, or even applying for certain jobs. But most people never learn how credit truly works. So, today we're breaking it all down in a clear, simple way you can start using immediately. And before we jump in, make sure you like, subscribe, and hit that notification bell so you never miss a new episode. Now, let's get started. A lot of people think credit is just a mysterious number that lenders use to judge you, but credit is really a financial reputation. It's a trust score that reflects how reliably you borrow money and how consistently you pay it back. Think of it as your personal financial report card. It shows how responsible you are with borrowing, how regularly you make payments, how much debt you're carrying, how long you've been managing credit, and whether you've had any major financial mistakes in the past. And here's the part nobody tells you. Your credit score doesn't just decide whether you get approved, it determines how much your borrowing will cost you. The difference between a poor credit score and a great one can equal thousands, even hundreds of thousands of dollars in interest over your lifetime. Now we need to talk about debt itself, because not all debt is the same. Some debt helps you move forward financially, while other debt pulls you backward. Good debt gives something back to you. This includes things like a mortgage that builds equity, student loans that support a valuable degree, business loans that help you grow an income, or low-interest lines of credit that improve your cash flow. Good debt usually has lower interest, predictable payments, and long-term benefits. Bad debt, on the other hand, takes more than it gives. This includes high-interest credit cards, payday loans, buy now, pay later debt stacking, and personal loans taken out for non-essential spending. Bad debt usually comes with high interest, impulse purchases, and no real long-term value. Once you understand the difference, it becomes a lot easier to decide which types of debt to avoid and which types can actually help you build your financial life. Your credit score is built from 5 key factors that influence how lenders see you. The most important factor is your payment history. Paying bills on time is the number one way to build or repair your credit. Even a single 30-day late payment can lower your score dramatically, so your best strategy is to set automatic minimum payments so you never miss one by accident. The second factor is your credit utilization. This is how much of your available credit you're currently using. If you have a $1,000 limit and you've used $500 of it, you're at 50% utilization, and that's too high. Lower utilization, ideally under 30% and even better under 10%, gives your score a big boost. Next is the length of your credit history. The longer you've managed credit responsibly, the better your score becomes. This is why closing your oldest account can actually hurt you. It shortens your history and reduces your average account age. The fourth factor is new credit. Every time you apply for a new card or loan, a hard inquiry appears on your report and temporarily lowers your score. Too many inquiries in a short period signals risk. And finally, your credit mix matters. Lenders want to see that you can handle different forms of credit, such as credit cards, loans, or a mortgage. You don't need everything, but having a balanced profile helps. Now let's talk about how to build your credit from scratch or repair it if it's already damaged. The easiest starting point is a secured credit card. You place a small deposit and the bank gives you a matching credit limit. Use it, pay it off each month, and within 6 to 12 months, your credit score can grow significantly. Another powerful method is becoming an authorized user on someone else's card, ideally someone with strong credit habits. This boosts your credit age, payment history, and overall profile. From here, the simplest but most critical rule is to pay every single bill on time. You can't build good credit if you're missing payments. Keeping your balances low is equally important. If you want an especially strong score, make 2 payments each month, one in the middle of the billing cycle and one on the due date, to keep your reported balance as low as possible. Also, Avoid applying for multiple accounts in a short period because too many hard inquiries can drag your score down. And don't close old accounts unless necessary because they help maintain your credit age and available credit. It's also important to check your credit reports regularly. Errors happen more often than people realize. You might discover incorrect balances, duplicate accounts, old addresses, accounts that don't belong to you, or inaccurately reported late payments. Removing a single error can boost your score overnight. Once your score is stable, you can move into the strategies that take you from average credit into excellent credit. One of the easiest ways to boost your score is to increase your credit limits. You don't need to spend more. Just having a higher limit reduces your utilization. Another method is to maintain a simple but effective structure of about 3 credit cards. One main card you use regularly, one backup card for rewards or categories, and one card you barely use that keeps your utilization extremely low. Paying off revolving debt like credit cards should always come before paying off installment loans because revolving debt impacts your score more heavily. Time is also your friend. A big part of reaching the 800s comes from simply allowing your accounts to age while staying responsible with your payments and balances. And you should avoid hidden credit killers like overdrafts, maxing out cards, closing accounts impulsively, or applying for multiple credit lines back to back. Even small mistakes can have long-lasting effects on your score. If you're dealing with multiple debts, you need a clear payoff strategy. The avalanche method focuses on paying off your highest interest debt first, which saves the most money long term. The snowball method focuses on paying off your smallest debt first, which creates quick wins and builds motivation. Both strategies work. It's about choosing the one you'll stick with consistently. A strong credit score is more than a number. It's a financial tool that affects nearly every aspect of your money life. A high score gives you lower interest rates, cheaper car payments, better insurance premiums, easier rental approvals, and far greater financial flexibility. Your credit score is part of your long-term financial identity. Treat it like an asset, protect it like a passport. If you found today's breakdown helpful, make sure to like this video, subscribe, and hit the notification bell so you never miss a new upload from Finance Girl in Cyberspace. I'm Heiress, and I'll see you in the next video where we keep exploring the digital universe of money, one smart decision at a time.